Dear students, today I will discuss module 17, which deals with the form of business, specifically partnership versus company. Now, why the form of business is so important? Because when you are starting a business, it's not that you are only doing the business. What is important is where you are doing the business, what form of business will take, that have certain tax consideration. Now, when we talk of the form of business, you will appreciate the form may be the sole proprietorship, maybe the firm, maybe the limited liability partnership, or maybe the company. So now, we will discuss today what are the comparative tax benefits between these two forms, that is the partnership and the company. For that, what I will do, I will take certain important points. Against that, I will discuss the tax implication from the point of view of the firm and from the point of view of the company, right? So, to start with, first is interest on capital. You know that when capital is given, in case of a firm, it is given by the partners. Now, the interest given allowable to the partners is allowable up to 12% per annum. In other words, if the firm pays interest over 12%, balance is taxable in the hands of the firm. Now, in case of company, you will appreciate there is no technical interest on capital because it is the shareholders who are subscribing for the shares, right? So, there is no question of an interest on capital. Then the remuneration. In case of partnership firm, partners may entitled to remuneration as per the partnership deed. Now, remuneration means remuneration may take the form of the salary, may take the form of the commission, bonus, etc. Now, for the point of view of the partnership, such remuneration is allowable subject to section 40B, because 40B deals with the limit of the remuneration. And what is that limit? The limit is on the first 3 lakh of the book profit, it is 90%. Or 1,50,000, whichever is higher, and on the balance it is 60%. That's the limit. So, if the firm paid remuneration up to that limit, the entire amount is allowable. But if the firm pays exceeding the limit, the balance is not allowable or it is taxable in the hands of the firm. In case of a company, what happens? A shareholder may be an employee. So, in that case, the remuneration payable to the employee basically allowable in the hands of the company. However, it is subject to two sections, section 40 small a, which talks of if the salary is remitted outside India, there should have been a TDS, or 40A2, there is no excessive payment should be made. Now, loan to partners or the shareholders. Suppose a firm makes loan to the partners, it is totally not any tax implication is there for that loan. But in case of a company, what happens? It might attract the deemed dividend. Why is it might attract? Because if the company is a closely held company and if the loan is given to a shareholder who holding 10% or more of the share capital, then this will attract section 222E, which is known as the deemed dividend, and in that case the shareholder has to pay the dividend distribution tax. Now, next point is the family planning expenditure for the employees. Now, family planning expenditure for the employees from the point of view of a partnership firm, there is no specific provision for that. So, what one can do that if there is any revenue expenditure on family planning, that can be allowed as a deduction under section 37. And if there is a capital expenditure like purchase of any machine, that the firm can claim depreciation under section 32. But for a company, there is a specific provision under section 36(1) subsection 9, which talks of that any family planning expenditure incurred by a company for its employees is allowable. How it is allowable? The entire revenue expenditure is allowable and capital expenditure is allowable in 5 years. In other words, you will get 1/5 of your capital expenditure every year. Next is point weighted deduction for scientific research expenditure, which is in-house scientific research expenditure. Weighted deduction means when you are getting a deduction which is more than your actual expenditure. In case of partnership firm, there is no weighted deduction. But in case of company, there is a weighted deduction of 150%, excepting for some companies. Next is liability to pay tax. Now, who will pay tax? In case of firm, it is a firm who will pay tax. In case of company, it is a company who will pay tax. Next point is the rate of tax. What is the rate of tax? For a partnership firm, the rate of tax is 30.9% without surcharge. And in case of company, the rate is 30.9% without surcharge. Now, the dividend distribution tax. Dividend distribution tax is applicable under section 15(o) on the dividend distributed by a domestic company. Now, what happens in case of a firm? There is no question of dividend distribution tax because a firm is not paying any dividend. The partners, what partners are getting as a share of profit. So, there is no dividend distribution tax. But in case of a company, there is a dividend distribution tax. And how it will be imposed? Any dividend received by a company from an Indian domestic company is fully exempted. So, no dividend distribution tax is payable. So, any dividend received by a company from a foreign company is fully taxable. So, you got to pay dividend distribution tax. And in case of deemed dividend under section 222A to D, in case of those dividends, it is the company who has to pay dividend distribution tax. But in case of 222E, which I discussed a bit earlier, that is, it is a loan given by a company to its partner, dividend distribution tax is payable by the recipient person, not by the company. However, from the assessment in 1920, in case of 222E, a company is also to pay the dividend distribution tax, not the recipient. There will be a change. Now, taxability of the income. And the company has to pay dividend distribution tax at the rate of 20.35765%. Now, taxability of the income means when a partner gets share of profit from the firm, it is fully exempted under section 10 subsection 2A. But in case of a shareholder, when he gets dividend, its taxability I just discussed earlier. That is dividend, if the dividend is received from an Indian company, no dividend distribution tax is payable. If it is received from a foreign company, dividend distribution tax is payable. And in case of deemed dividend, if it is under 222A to D, dividend distribution tax is payable. If it is 222E, no dividend distribution tax is payable. Next is the scheme of taxability. Now, in case of a partnership firm, it is subject to alternate minimum tax under section 115 JC. In that case, a company has to pay tax on normal income or tax on adjusted total income, whichever is higher. But in case of company, it is not the AMT, it is the MAT, which is minimum alternate tax under section 115 JB. Conceptually, it is the same, rates are the same. In case of both the cases, the artificial rate is 18.5% plus. Now, the question is in case of MAT, once again the company has to pay tax, whichever is higher of the following. That is, number one is the tax on normal income at normal rate and the tax at the rate of specified rate, that is 18.5% plus cess come to 19.055% on the book profit. In case of firm, it is the adjusted total income, but here it is the book profit, whichever is higher. Next one is the presumptive taxation under section 44AD. Now, the concept is, what is the presumptive taxation? Presumption means assuming. I am assuming this is your income. Now, there are three presumptive taxation broad scheme, 44AD, 44ADA, 44AE. Now, in case of 44AD, it is whatever you earn. If you are under 44AD, if your gross receipt revenue doesn't exceed 2 crores, notional income to be computed at the rate of 8%. But if you are receiving out of this revenue some part either in account pay check or through electronic medium, then it will be taxed at the rate of 6%. So take an example. Suppose your revenue is 1 crore. So it has been assumed your taxable income is 8% of 1 crore on which you got to pay tax. Now in case of 44AD, it is applicable for a firm, but it is not applicable to a company. So a company cannot take the benefit of the 44AD, that is a presumptive taxation. And then presumptive taxation under section 44AE. Now what is 44AE? It is basically the business of hiring and plying goods carrier, right? So if you are doing a business like that, there is a specific provision that how your notional income will be computed on which you got to pay taxes, right? The provision is earlier to before 1920 the provision is 7,500 per truck up to 10 trucks during year. If it exceeds that, you won't get the benefit. From 1920 things are changed. They got heavy vehicles which is 12,000 kg or more, 1,000 per kg, and for the other than the heavy vehicle it is 7,500 per month. Now very interestingly, this scheme is applicable to both partnership and the company, right? So if business of hiring and leasing goods carrier is doing by a firm, they can enjoy 44AE. If it is done by a company, they can enjoy 44AE. So these are the different tax benefits or taxability that I have discussed from the point of view of these two entities. So while you choose which form of business you will take, you should consider all those things into the mind. Thank you.